Hey everyone, thanks for tuning in. Happy New Year. Hope your 2023 is off to a great start. I want to talk a little bit about the commodity markets first here. And so you can see that the commodity markets overall, which the fertilizer markets are part of, have been very range bound for most of the last several months. And so it's not unusual though for commodity markets to be range bound. If you look at 2019, you can see that for most of the year, commodities traded in a pretty choppy and directionless market. It was only once COVID hit in early 2020 that we really saw prices on the commodity market just drop to the bottom and then really spend the next 2 years surging up to levels that we haven't seen in many, many years. And so commodities really have to balance the fact that you could be potentially facing a global recession, along with the fact that you have China coming back online here right now once they get through their own COVID scare. And so, tough to say which direction commodities go from here, but important to recognize that fertilizers are just one more commodity, and these things tend to move together overall. One commodity that has been on the decline is European natural gas. And so you can see that down from its historic highs, now trading around $22 an MMBTU in the prompt month. When you look ahead at the forward curve for most of 2023, it's trading in the $23 to $25 per MMBTU range. And a good reason why that is happening is just the sheer amount of warmth that Europe is seeing right now. And so this is a temperature anomaly chart. You can see that for most of Europe, temperatures are 20 degrees above normal. You can also see that in most of Russia, temperatures are around 30 degrees cooler than normal. And so this is about as close as you get to having your partner steal the covers. If any of you share a bed, you know what I'm talking about. It looks like Europe stole the covers from Russia. You got one section seeing unseasonably warm temperatures and one seeing unseasonably cool temperatures. It's potential that Mother Nature is taking sides in this war. So I think you can see who Mother Nature is choosing right now. Looking at ammonia prices and jumping into the fertilizer markets, ammonia has been on a steady decline here lately. The Tampa ammonia contract for January settled down $55 a metric ton to $9.75 a metric ton, which is the lowest that we've seen since July of 2022. And so the big thing to keep in mind, those last two graphics that you saw, is what happens with European ammonia producers and really nitrogen producers. So for those folks who are doing upgrades, do you start to produce your own ammonia, or do you import the ammonia and do your upgrades from there? And so if you find that those European producers start to produce their own ammonia again, you could see additional pressure on the ammonia markets going forward. Moving into urea, urea has started 2023 on a pretty weak footing. And so, from a technical or a chart standpoint, we've reached a multi year support line. And so, we've tested this multiple times over the last year and a half. And so, that does not bode well for the product line. But from a fundamental standpoint, the US needs to attract a pretty substantial amount of additional urea in the first half of calendar year 2023. And so our estimates would indicate that we need to import around 4 million tons of urea between now and the end of June, which is a pretty substantial amount. But globally, there are some slower aspects right now. You've got India, who still has not called for another tender. You've got Egypt, who saw prices as low as 495 a metric ton last week. And so a lot of that is continuing to burden the market lower while we wait for demand to kick in. The question is, how long does it take for demand to kick in? And once it finally does kick in, what happens to the price? Moving on to UAN, you can see that UAN, like all nitrogen products, continues its slide also. Ohio River terminal values are in the $480 a short ton range. Looking at those same import numbers that we looked at for urea for the July to November 2022 period, the U.S. exported 900,000 tons more of UAN than we did in the same period of 2021. We also imported 150,000 tons less than we did for that same period. So we saw the trade balance be reduced by 1 million tons in that 5-month period. And so that's just a 5-month period. If you annualize that in a UAN market that has maybe 13 to 14 million tons of overall demand, it's a pretty substantial number. That being said, given the premium of UAN to urea, we could reasonably expect that nitrogen producers are favoring UAN over urea, and that should help to cover some of that deficit. Looking at nitrogen, the major nitrogen products and comparing them, Here's where we hold ammonia steady and then look at the upgrades to see what the premium or discount is. And so you can see UAN is trading within that same premium that it's been trading in for the last several months. And so it's fairly range bound and appropriately priced to ammonia. Urea just continues to bounce around. It's still at a discount to ammonia, which is fairly unusual, or it should be unusual. Moving into the the sulfur market continues to soften, and part of the reason for that is that refineries are now at max capacity, and they are creating a lot of sulfur in the process. At the same time, overall global fertilizer demand has gone down, and so you're not consuming as much sulfur into fertilizer products right now, which is also pressuring prices. Looking at ammonium sulfate, the price of ammonium sulfate continues to be unsettled, generally dropping ever since the summer fill program here. And so if we want to look at ammonium sulfate from a slightly different way, keep in mind that most of the ammonium sulfate sold in the US is a caprolactam byproduct or co-product. And but the marginal producer is taking ammonia and a sulfur stream and typically producing ammonium sulfate. Oftentimes this is a white product in color. And so what we're going to do here is if you take the red line, that is your corn belt ammonium sulfate price. And then if we back out the nitrogen portion of that using the price of urea, we're left with what the sulfur value of ammonium sulfate is. And so you can see that about 60% of the price of ammonium sulfate today is the nitrogen component. The remaining 40 plus percent is the sulfur component. And so keep this chart in mind because the next chart we're going to look at takes that same gold line, which was the sulfur, and it breaks it down per unit of sulfur. So there's 24 units in ammonium sulfate. You can start to see the per unit cost of that sulfur. And then we're going to take that yellow line and compare it. And so that yellow line is the Vancouver index price, or it's actually not the index price, it's just the price, the spot price of Vancouver sulfur, which is a major benchmark. You can see that for most of 2021 and into the spring planting season, AMS, the sulfur component of it, was trading at a discount to that Vancouver sulfur value. And now it's been trading at a premium. And so if we get back to that historical norm, you could potentially see further price depreciation in the sulfur market and then the sulfur component of ammonium sulfate. And so tough to say where this goes, but certainly doesn't bode well for the price of ammonium sulfate. Moving on to dry phosphates, you can look at the global value here and see that really since mid-November, international MAP values have been back on the rise. So the question is, have we bottomed out or not? The thing to recognize is that it's January. The world now needs to start, especially Northern Hemisphere, it needs to start getting ready for spring applications. Looking at the barter rates, I brought this up the last several months. The price of MAP continues to follow the barter rate historical trend here. And so that would indicate that there's the market has bottomed out and potentially could see some increases through the spring season as that barter rate increases. This is a chart showing the U.S. Gulf MAP-DAP price trend, and you can see the red line. U.S. Gulf DAP is now trading higher than U.S. Gulf MAP. And this is unusual, not something you normally would expect to see. If you go upriver and look at Cincinnati, you can see that DAP is trading at a premium to MAP. And that again is unusual. And in this, in the 3 or 4 years that this chart represents, that hasn't happened. Typically, the best you'd see is that DAP trades at parity to MAP. And so a couple of things are going on really in this market. One is that there's been domestic curtailments of DAP production, and so that is leading to a tighter market. And then if you look back historically, just at where the U.S. has typically got DAP from, back in 2020, we closed, 2021, we closed a lot of those folks out of the market. 2020 is actually the year when we did countervailing duties. But you'd say, well, we haven't seen that in the year and a half, 2 years since those were put in place. And so it's really the fact that you had that combined with these domestic curtailments are now leading to this situation here. Finally, wrap up with potash. So I'm filming this on Monday of this week. And so sometime, hopefully soon, we would expect an imminent potash fill program to come out. And so you can see that the price of potash has been on the decline really for several months now. So the question is, what will the market clearing value of the potash fill program be to encourage buyers to participate in this market? A few ways of looking at this. One, this is the barter rate. You can see that we continue to be above the historical barter rate on potash right now. If you were to get back to the historical rate, and value, it would result in about a $25 decline in the price of potash, which would get us into the high $400 range. Let's call it like 490 for a Corn Belt value. If you were to look at this from a spread to NOLA, you can see that this time of year, normally you expect about a $40 spread to NOLA into the Corn Belt. We're trading at about an $80 spread to NOLA. And so that would indicate about a $40 drop, which would be, again, high 400s in terms of price. But when you start to compare the fact that potash is sold globally and the US has to compete for granular potash against the rest of the world, Brazil has started to engage. And so with that, the Brazilian price has not only stabilized, but started to rise. And we'd expect Brazilian buying to start to pick up over the next couple of weeks. So given the fact that NOLA values are $40, potentially, or Corn Belt values are $40 higher than where they could be relative to NOLA, and that the US NOLA versus Brazil spread is about $40 off of that little bit, you could really see NOLA values hold steady to maintain this typical Brazilian price spread. And at the same time, you can see Corn Belt values start to come down a little bit. So one thing to remember with all this is that most retailers ended the fall season with really no potash in inventory. And so for us to get ready for spring, we're going to have to really see a pretty decent amount of restocking to be able to prepare for that. And so that would be the bullish factor. And so a lot of different things to keep in mind as that fill program comes out. One last one that I'll leave here is the fact that if we zoom out and look at the potash market over a multi-year view, and really going back to 2010 here, you can start to see that markets like potash and phosphates, for the most part, tend to get into trends. And once you get into one of those trends, it's very hard to reverse those trends. And so if you look, I've put little blue circles here, and that is every time the weekly price, which is that red line, crosses over the black line, and which is the 6-month moving average. And so typically, once the weekly price crosses over, you typically see one of these trends go on for about 480 days. So we are about 160 days into this. So this trend is potentially in its infancy. Doesn't mean that you couldn't see a trend reversal, or at least that black line catch up to the red line at some point, but typically takes a very long time for that to happen. I did highlight back in 2017, there was one false signal with this where prices did cross over that 6-month moving average line. And so even counting in that in the 480 days range, you can start to see that typically these trends go on for quite a while. So that's all I have. Thanks so much for tuning in. Hope you all have a great start to your year. Thanks again.